Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. Sitting next to Jeff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. So this is breaking news. I had to cut Jeff off in what he was saying. He just told me that he's drinking 3 to 4 Celsiuses a day.
Right, that's true.
And you're not drinking coffee anymore.
So if I keep up the Celsius, then I can not drink coffee, yeah.
So on the can, it says do not exceed 2 within a 24-hour period. You're doubling that.
Yes, that's true.
And you like the cola version too, which we were just talking about. We were laughing about because I don't know. I never see cola anymore.
I know, that's a problem.
And that's your favorite one.
Like this is the problem, is that I don't like any of the other flavors. They're big on fruit flavors, which is not my thing. Yeah,
those are the best ones.
They must be, because if you look at the shelf space, they devote to it. Yeah,
I actually tried the grape version recently, but look at this. So if you're looking on YouTube right now, look at this. Is all Focus Compound's fault. Celsius, just cans of Celsius. Every time I open up my Twitter, I'm seeing pictures of people drinking Celsiuses.
Yeah.
And, we didn't invest in the company. Have you done the math on that by when we looked at it?
What it would have been, I don't know. It would have been 10 times or something. What's it been?
Oh, I think it's up like dramatically. I think it was like, it could have been like, depends how much the investment would have been, but 2, 3 to 4 million to,
what's the price of sales?
70 plus million.
What's the price of sales now on it?
Yeah. Let's take a look at our friend Celsius right now. Celsius Holdings, ticker CELH.
Yeah. So it would be over
7 billion. We looked at what?
It would be probably, over 10 times just in terms of multiple expansion. Then there's also that sales have gone up too. But even if sales hadn't gone up, yeah.
Wow. We'd be like, we probably wouldn't be recording this podcast right now. We'd be gone.
Yeah, it is a $7 billion company with 100-some million of sales.
Yeah,
even if they grow at the same rate they are this year, next year they'd be like 200 million sales. So I mean, that's a big valuation to put on something with that amount. Yeah,
that's crazy. Absolutely insane. Anyways, if this is the first time you're tuning in with us, hit that subscribe button wherever you are watching or listening to the podcast. If you are watching the screen right now, this is QuickFS. This is the software that Jeff and I use every single day. Go to quickfs.net, and if you do sign up, tell them that you heard of them from Focus Compounding. If you did not hear of QuickFS from Focus Compounding, still tell them that you heard of them from Focus Compounding, because we get a piece of that. So that's a lot of fun, and we use this every single day. So in today's podcast, Jeffrey, I guess before we dive into it, the people want to know, did you see the new Bond movie?
I did.
Of course you did. Yeah, I knew you did. I didn't know you did. Yeah. I didn't ask, but I knew that you did. How was it? How did it do at the box office? I think it was disappointing, I heard.
Well, it's complicated. I'd say it did exactly as projected. However, it had very big preview numbers. So the way that this works, everyone projects these things. Like I think we mentioned the numbers projects it and stuff, but the distributor projects it. There's all these things. And so as things come in, it's sort of like election night, they start to use the data that they're getting in.
Sure.
So if you look at what it did on the night that it would have opened, which I don't know if that was a Thursday or whatever the preview audience was, it would have been like they would have started thinking it could be 90 million or more. And I would guess, I don't know what it came in at, but I would guess a little less than 60. Well, it did come in at for the weekend.
Let's see. Domestic box
office. Go to box office there. It shows you the weekends if you go down probably. Yeah, what does it say for it? The weekend number for the US? It doesn't say yet.
Is it the 55 million?
Yep, so 55 million. So I would have guessed it would be like 60. So, but based on that, the number of the first night, if the normal multiples hold, that would have been like 90 to 120 million, which it was never going to do. It's doing big outside the US. I would guess, we can try predicting here. My guess for people listening is it'll do around 150 million in the US.
Okay.
And I'm going to go with almost as much as 500 million outside the US.
Did he die in the movie?
I can't.
Let's ruin it for everybody. Did he die?
That's what I want to know. That information.
Did you like it?
It's the longest James Bond movie, I would say. Yeah.
How long was it?
I believe it's 2 hours 45 minutes, which also affects box office because obviously that limits the number of showings you can have. I saw it in IMAX. So it's a big issue for IMAX and stuff like that because IMAX now can only show it some like the theater I went to only has one IMAX screen. So you can give a lot of screens generally, but you only have one IMAX screen to give. And so they're showing it once every 3.5 hours, something. They got to show it at the moment they open the place, and they got to show it the last minute that they're open too, to make enough money from it. Very full when I saw it, but again, that's like apparently it was front loaded. So And so what is that? That could mean things about COVID and stuff too, because it's an older audience.
Mm-hmm, sure.
And it's skewed more male than is normal. James Bond always skews male, but not as severely as it happened here. I think it almost 2-to-1 male. And so women over 35, I think they've mentioned in the numbers and places like that, we'll talk about it, may be a reason for why you're not seeing as much later in the weekends and stuff, that you're seeing more diehard fans of any of these things, whether it's Bond or Marvel or any of those, that you're not getting as much of the audience you would get later on. It just is a general phenomenon that they're definitely more front-loaded, most of these releases. So they're making more money early on and not making money later. Sure. So it may be that half of the people in the US or whatever are just as eager to go to movies or more eager, and then some percentage of them are not. It's probably, and that has an effect. It has an effect on the window. For instance, there's no need to, Bond, Skyfall was different. But if you put that out, exclude that, even a Bond movie, it's not that important if they show it after the first 4 weeks. If it has figures like this, and we'll see how it holds over the weeks, but there's really no need to run things in movie theaters for more than about 4 or 5 weeks now, I would say. They just don't. I mean, you're seeing drops. They'll make 50 million or whatever this weekend, then you'll make like 25 million the next weekend, 12 million at best, the way that movies are going now. For a lot of movies, the drops are a lot more severe than that. And so you can do the math. There's no point in week 5 to keep showing it. So, yeah, and this was not a day and date one, so it didn't come out at the same time on HBO Max or any of those sorts of things. Obviously, it's a different studio doing it, but that may have also affected some of the other movies that have had kind of softer openings and stuff too. But yeah,
and you liked it?
Yeah, I'm not going to comment on that.
Does he die at the end?
I'm not going to comment on that.
So you did not like it, and he does die at the end.
I'm not commenting on any of those things. Yeah.
Perfect. Do you know what industry you and I probably talk about the most on the podcast? Or, I mean, not on the podcast, but even just, I feel like, amongst ourselves. I feel like we talk about banking the most from like industry perspective. And,
yeah, that might be true, yeah.
And I think it's probably one of the most interesting industries in the world. But I came across this essay that I thought would be great content to go over on the podcast. And this is from maxfieldonbanks.com. We've talked about this website once before. You should also follow him on Twitter. I'll put all of his information down below. But this is a great website to also get a bunch of books that he recommends on banking. Mm-hmm. I've found a couple of books from here as well. Still working my way through more than half of them. But if you're interested in banking, this is just a cool website to to familiarize yourself with. But he has essays on here, which I'm hoping us doing this podcast will prompt him to do another essay, because this last essay was great. Yeah, okay. And it was November 10th, 2020, and it's 20 lessons about banking from 10 years of study. And there's some interesting things in here. Some things that we would say, some things that we wouldn't, but I just thought it would be cool to talk about it and just kind of see where we go with it. And he thinks, and I don't know if he listed these from like importance or not, but number one, fortunes can be made in banking, but only by earning consistent returns through multiple cycles. So you've actually written about that before, the consistency of it. So the type of business that they're doing, the type of lending that they're doing, the type of bank that they are, and the quickest way, which he actually lists later on in this list, a good way to sort of sanity check a bank or check the level of risk of a bank or the people running it is really just go through like the last crisis, right? So like 2007, 2008, 2009, to see, what they were doing or how they did or how they fared out through it, if they did.
Yeah. And also related to what he was saying there is you can't get rich quickly. The returns in any one year, because you're constrained by capital levels, can never be that big to make up for having some down years in other parts of the cycle. So I was reminded of that because I was just reading something about Buffett's investment in Geico when he was an individual. So just buying it for himself in the very early 50s. And on average, the stocks that we own are now bigger than Geico was when he bought into it, when you adjust it for inflation and stuff.
Really?
So, yeah. And so he saw the advantage that it had. It was already a couple decades old at that point. Insurance similar to banking. And it's been 70 years. And they've, there was a 10-year period where they didn't really gain market share, but otherwise they've gained market share all the time. And they're still, growing and profitable and all of that, but it's still that same steady rate throughout that whole period. And they probably would have been, I would guess that Geico has compounded at least 15% a year.
Well, I was going to say,
the value. Yeah.
Do you remember we did the math on the growth in premiums over the 60 or 70 years or whatever data we had when we went over the annual report in his chairman letter? And it was like what 14 to 15%, if I remember correctly.
It's like 14% or something. Plus they got returns on their investment that way and stuff. And you can also guess based on what Progressive is valued in the market at, what Geico would be valued at. I think it's a pretty good proxy for it. And yeah, it would probably be about 15% a year or something for 70 years. And it didn't do badly before Buffett bought into it either. I mean, that was the startup phase. So it just gives you some idea that it's basically made all its money from doing the same thing and earning high returns on equity, but never, there's never any period in which it grows like, it would be listed as one of the hottest growth stocks or something. It's just consistent performer decade after decade with one big exception.
Mm-hmm. Got it. Number 2, the archetype of extraordinary bankers doesn't match the stereotype.
Yes. Yeah, I would agree with that. But is that the stereotype? I guess the stereotype of a banker is more like investment banking, deal making.
That's what they think about. Yeah.
Yeah. Okay. I feel like that the first thing they're describing is kind of my stereotype of what a banker would be.
Just very cool, calm, and collected. Even keeled, not
well, you have to not get caught up in
the craziness.
Yeah, Buffett said, I forget.
He's got that on here too.
In one of his letters, basically, he said, for the most part, banks really have gotten in trouble just on the asset side. Mm-hmm. They haven't really gotten in trouble usually on the expense side.
So do you want to explain that?
And liabilities.
So assets meaning the types of loans that they're making.
Yeah. And in some cases, it could be securities you buy, but it's definitely generally been loans. Yeah, and they're different each time, but there have been a few crazy things over the years.
Well, that's like the institutional imperative thing, right? And how Buffett talks about resisting it. And I think he's actually used banking as an example of that.
Banking and insurance are the best examples because there's nothing about the history of your organization usually that, like, if you were determined to shift in some direction, would stop you, right? So, most businesses have more real stuff that isn't capital that you get to redeploy. So you're limited in some ways. Your brand is positioned a certain way, it's distributed a certain way. You can't suddenly go in a different direction. But banking insurance, you can. And so you can certainly enter a different kind of area and take risks in it pretty quickly. And that's kind of what Buffett was talking about, I think. And then often it's the area that is growing faster. I mean, that's been my experience, and not just in banking, but in other industries. I always talk about how it is helpful to have at least some level of organic growth, some unit growth in a business, because it acts as a safety valve. Also dividends do, but it acts as a safety valve to keep the company from going into different areas when its core business slows down and doing dumb things. And that often happens. You go into some other area that way. I mean, I've talked about that because I wrote up one of the Hawaii banks one time and stuff, but they've done that consistently. All the banks in Hawaii at some point have kind of decided, okay, let's do some business outside of Hawaii, and it hasn't gone well for them. And, it's usually at a point in which they're not growing as fast as some of their peers could be, but they're not even located in the same place as the peers, but they're still benchmarking themselves off of that and saying, we need to do that, and so I think that's, that whatever it is, envy or whatever, that trying to pursue that growth. So your biggest risk is when your original growth stuff kind of slows down. That's not naturally there, and you have to make changes.
As an investor, how would you monitor that? So if a bank in Hawaii was going to enter a new market, for example,
I would get out.
Interesting. Okay. Yeah. Even if the market was, I mean, is that specific to that situation, or? Because they're in Hawaii and going more to more inland. I mean, how do you kind of handicap that? Because, and the reason I ask is, I mean, we know of banks, for example, that are expanding in new markets and stuff like that. So it's just like, how would you sort of monitor that?
Yeah, someone was talking to me about a bank in a very small area recently. And honestly, that's my biggest concern. They will outgrow that and they'll want to do other things, and there'll be some risks of doing dumb things. It's safest if you have your past, what you've done in the past lines up well enough with future growth. And so that is why things like, when we're talking about the insurance things, the auto insurance and stuff is helpful because you don't outgrow that kind of niche or whatever. Mm-hmm. It is more of a problem in other banking things that way. So I think it's difficult, honestly, for things like Hawaii or Ireland or whatever to expand into other places because it's not natural the same way that would be if you were just a bank in the U.S. that could slowly expand into different markets that have some similarities to your market. Your home market doesn't. So I'd be aware of that and be somewhat concerned about that because it's unique, the market that you're in. Mm-hmm. Same thing for Alaska in the U.S. and stuff. So you kind of have to make a decision about that, where it's a lot easier if you're just in one part of Pennsylvania and then you expand to other parts of Pennsylvania and then you expand to Ohio and then, that's a much more natural sort of process. Mm-hmm. I mean, like with the Hawaii thing, they had to decide where they wanted to go, California, Guam, places like that. And that's what
were they doing different types of lending when they left Hawaii?
That's also another issue with it. Yeah. That sometimes you do different kinds of lending. Often you do. Yeah.
Interesting.
So like the example I gave, like the most extreme one in terms of Hawaii and stuff that I was worrying about a different company, not the same bank, is they made a lot of loans fast in California and tied to construction, whereas they weren't necessarily did as much construction lending in Hawaii, and they hadn't. California and Hawaii aren't the same thing exactly. Mm-hmm. So it's a little dangerous, and you're probably not going to see the best deals and things. I mean, it's like we're talking about movies and stuff. That is an issue for Amazon Studios or whatever, right? Amazon Studios or a company like that wants to make a movie. They will, literally see something that all the major studios have passed on. That by the time it comes to your desk, it's already been passed on by everyone else.
Yeah.
They're not going to say, I really want to make it with Amazon.
Yeah.
Right. So, which is fine. I mean, there are probably some good deals in there to make, but it is a problem. And so if you're new to a market, that is a bit of an issue. I don't know how you would think that you could make construction loans better than people who are already in the state doing it. Because I just think you see the most marginal stuff that way, which, it could be good. There could be ways of doing it, but you always have to be careful about that. The new entrant stuff is going to tend to see the most marginal stuff, and that's what you have to be careful of.
Got it. Number 3, darlings in one era are often pariahs in the next. In 1978, Continental Illinois National Bank and Trust Company of Chicago was named one of the 5 best managed companies in America. 6 years later, it failed. This is a common narrative in banking.
Yeah, I don't think it's just banking, but yeah. I mean, GE was probably named the best, Enron, those sorts of things, not that long before a period in which they had bad results.
It's almost like the halo effect.
I guess a lot of it is short. A lot of times is that they're telling you, like, your stock performance and things like that. They're kind of grading you on things you did a long time ago that's now bearing fruit now,
sure,
and not on the stuff that you're doing recently. Yeah. And so,
it's like when Jeff Bezos, he said that every time people congratulate him on a quarter, he would be like, well, thanks, but I'm already, 3 years ahead thinking about the next, it's like we did that work a long time ago. And we're just now being thanked for it. You congratulated.
Read that Amazon book that you were talking about?
The new one?
Yeah. Mm-hmm. Yeah. And so a lot of things that performed well in terms of revenue sources and stuff later, they talk about in that book how long ago they were developing them and put the effort into them. So in a lot of ways, like, people get positive about Amazon in 2015 when it was really stuff that they were doing in 2010. Mm-hmm. And so the organization may have changed. It may not, it may be different now what they're working on than the things that paid off in the past. So yeah, I think that's true with any of these. And they also, these lists and things usually show the companies that have the fastest growth and stuff. And as I said before, in financial services things, insurance and banking, rapid asset growth is the biggest thing. Like, if I was a regulator, the number one thing to warn about is rapid asset growth. If you're growing your assets faster than peers, and if you have a sudden increase in the speed at which you're growing your assets, then you need to zero in on that and really focus on that more than any
see what they're
thing.
Doing.
Yeah. Yeah.
Got it. Number 4, the most effective cultures are grounded in altruism and universal human desires. And he says M&T Bank's mission is to make a difference in people's lives. BB&T's mission prior to its merger with SunTrust Banks was to make the world a better place to live. It isn't a coincidence that both banks have produced long-term results that are the envy of the industry.
Mm-hmm. I don't know. There's a few that had mission statements to basically put people in houses and things like that, and things that sound good but are bad. So I find that hard with mission statements always. However, it probably is good not to have a culture that is so based on meritocracy or whatever inside the organization, incentives, that you're not thinking about it as a team and the organization overall, but just like literally what is it worth? What are you worth to the organization that way? I mentioned Enron. That's a really good example. And AIG actually too. Enron and AIG both had that sort of thinking. A very incentive-driven way people would like, kind of the incentives that investors usually talk about liking a lot. But it led to a tendency to just worry about your own business, how much your bonus was going to be, and not worried about what this meant for the organization, that you were piling up risks and things. Yeah.
Yeah, it's interesting. Buffett's talked about how when he was at Salomon Brothers, for example, he would give some 28 or 29-year-old, I think is what he said, a $2 million bonus, and he'd be so happy until he realized that somebody that he worked with or an associate made like $2.1 or $2.2 million.
I've seen that myself with people I know in investment banking. Yeah, the exact thing you're describing. Happy with the bonus, and then found out what other people made. Yeah,
and not happy.
Yeah, because the bonus means other things that way.
Of course, yeah. It's like the hierarchy.
And in other organizations, they give it out in other ways. It can be titles, it can be offices, but it's signs of the favor of whoever. There. Yeah. Mm-hmm.
So then I guess the question is, what do you think is the most effective culture in a bank?
That's a very good question. I don't think I know enough about it in most places to know for sure. I do think that evaluating risks organization-wide by some people who are involved in the overall running of the business is the best way to do it. That's the one thing that I kind of would feel is consistent throughout learning about things in insurance and banking. Not having, not separating out kind of risk control, thinking of it as something different. So that's what you don't want, I think. So it's something that, like when I mentioned AIG, for instance, AIG had an issue that they lost, they pushed them out and stuff for legitimate reasons, but a CEO who had a different attitude about risk and was very aggressive in finding it in the organization and dealing with it. And I don't think that other people really knew the risks that they were taking firm-wide. And so I think they need to be at the top. The chief risk officer or whatever needs to be the CEO, basically. I think that's the most important thing, and not to feel like somehow it's put off on someone else. I mean, that's what people always believe is like, in a sense, if there's some independent source that's checking off on you, that kind of actually can be worse because you have some standards that it met. And so then people kind of feel like it's not my responsibility. Mm-hmm. Yeah. So it depends. I mean, I wrote about Car-Mart and stuff. Car-Mart, there's some different insurers and things that do things on stuff that's very long-term that the results could be. That ties stuff, it's basically clawing back and stuff. Things tied directly to decisions that you made because they can't see the full result of your decisions within the first 12 months. So there's some stuff that goes longer term. So they want to avoid giving you a bonus and stuff that will reward behavior that looks good in the first year but doesn't look good later on. So that's important, Mm-hmm. And you saw that, Wells Fargo with the incentives there. They had incentives designed to do something that's very logical for their business. But then, of course, people go focus, that those incentives drive behavior even when it's something that you don't want.
Sure.
Yeah.
5, bankers make better decisions when lending their own money.
I don't know about this one. I don't know.
Okay.
A lot of people think skin in the game is a good idea. And there's certainly people who sold money and who sold stock. I'm not as convinced in investing in general, whether it's banking, insurance, or just other businesses and stuff, whether skin in the game is as important as the other people believe. I don't believe that organizations that bring themselves down when they don't have money in it would have necessarily behaved that differently if they did. I think they honestly believe what they're doing is right and cannot fathom that it would end this way. Countrywide, there's plenty of skin in the game. Now there were some sales, I think, before the end there, but of the investment banks, I just reread The Greatest Trade Ever. Whatever, the most skin in the game was probably the ones that went down. So Lehman and Bear at the very top people in the organization probably had the most. Certainly Bear Stearns, CEO, kept every penny that he could in the company, and did not sell at the rate that other people in other organizations did and stuff, and basically lost everything. There's a lot of skin in the game in Lehman. So I don't think that they thought they were taking the risk people think, outsiders, and I'm not sure I agree as much with the idea of moral hazard and all of that.
But the other side of that is, I mean, you would prefer, I imagine, to have some sort of skin in the game, right? Than just completely nothing.
I think skin in the game matters, but not for the things that people think.
Got it. Okay.
So I don't think skin in the game has much to do with massive risks. I think that people who own a lot of business may take massive risks with it, and others, both if they owned a lot of the stock or if they didn't own a lot of the stock. I don't think it would make a huge difference if the CEO of GE owned a ton of GE stock or owned no GE stock in terms of whether they took risks they shouldn't. I do think it has a big impact on making decisions and taking the initiative on things that require a little bit of initiative against like the institutional imperative type stuff. So I do think that people with skin in the game would have lower expenses, for instance. Instead of being satisfied with the expenses that other organizations have. Continual improvement type stuff. I do believe that. Making decisions that are more difficult from a personal perspective, a cultural perspective, just unpleasant, non-financial things. I think that having a lot of skin in the game does incentivize people to make the right financial decision at the risk of being less well-liked and stuff like that. So I think that's important. But I don't think that it has to do with like catastrophic risk. I don't think that anyone who ran their bank into the ground would have not done it if they had their life savings in it. I just don't think that they believed that they were taking anywhere near the risks that they were. I think they slowly took more and more risks. And, my suspicion is that's the reason why. And the personalities of the people and stuff like that. So in that sense, I don't believe skin in the game is as important for avoiding catastrophic risk as people do. I do think that it is important for setting very high standards inside an organization when the outside world doesn't set as high standards. So benchmarking yourself to yourself instead of your peers.
How much of it do you think is inertia of like you just have to keep dancing while the music is on? Like how much of these companies, it's like they didn't want to get off this treadmill prior to the financial crisis, because all the major banks, even like Goldman Sachs, all of them, they were like producing like record EPS numbers, record everything.
I mean, the bad news is I think it is fairly innate. And often you can judge by how people talk about risk and things, in all different respects. I was reading a book about the financial crisis stuff. It covered a bunch of these different investment banks and things, but there's one scene in which someone's talking about it like a risk thing like you're talking about, and it was a group that was doing arbitrage stuff, and so they just asked in the meeting, so this position, what's the chance that this deal goes through? And they said 99%, and the person who was involved with the overseeing the risk stuff went ballistic because they're like it's not 99%. I mean, I don't know anything about the deal, but I can tell you that you're insane, that it can't be 99%, and nothing is a 99% chance of that happening, and and Buffett would know that. I mean, the even if you were certain of that deal going through, there's a 1% chance of things happening in the world that no deals will be going through in like over a period of a year or something. Now this was a shorter period. But so it's an attitude about risk not to consider things in that, those areas. And so some people have a lot of ways of thinking about risk that deal with that and others don't. And I think it's hard for most people and most organizations to see the risks that they're taking when others are also taking them, and particularly when they're not having their attention drawn to it. So everyone's very concerned with a risk when your attention is focused on it, but no one is concerned with that risk otherwise,
Sure.
So, say China or something, right? So people might be concerned about possibility of crackdowns on internet, whatever things. And so their focus is on that, right? And then if I asked you what's the percentage chance that there'd be a problem because China invades Taiwan, They haven't thought about that. So it's a 0%, not a 0.5% risk or a 0. And if suddenly there was news about that instead of news about other things, then they would quickly shift their risk perception of it a lot, just because their attention was on it.
Sure. Yeah.
So you're paying probably too much attention to the things that are present as risks now, and too little attention to like things that might never happen or something. Like just thoughts that people haven't had yet. And when Buffett sold the GSEs, and that's the kind of person that you want in terms of worrying about risks, because they took seriously their own perceptions of what risks can happen, even though no one else was, and there was no indication that it would happen anytime soon. And that's the best time to deal with it. Even when we're talking about the mortgage things and whatever with those investment banks, if you're the first one to realize this, then you can get out of the position in a much better way than others.
Yeah.
And so you need to realize, there's a problem here, and we need to start acting on it early on before everyone becomes aware of it. And most people's is, honestly, a lot of people know it's a problem. They monitor it, but they don't move on it fast enough.
Like wait and see what happens.
Yeah. And a lot of times they do silly things like, we'll take some risk off of it. So we'll own mortgages, but we won't own any of the worst mortgages. We'll own only the very best subprime or whatever, even though we know that it's an overall potential problem. Or we think we're protected by owning the best in some industry that we think is dangerous. So like an investor will be really worried that home building will have a huge crash or whatever, but they'll have one home builder that they really like, and they'll own that one, and they'll think that protects them versus others. Because they, again, like benchmarking versus others, they're taking less risk than others, but that's not what you get rewards for and stuff. It's not that you take the least risk of anyone in that area. It's that you actually have to take enough that you're safe with what you're doing. It's, yeah. Maybe Lehman took less risk than Bear Stearns. I don't know. You could have taken one organization could have taken relatively less risk than another and still failed, because you shouldn't assume that only one will run into problems, and like that. Or the one that always bothers me is, insurance things or whatever, where they say, modeling off of the worst of this event that ever happened, well, in the future, there'll be one that's worse than that one.
Yeah.
So that's, one of the things that you want to keep in mind.
Interesting. 6, the crux of banking is watching what others are doing and then not doing it yourself. Kind of just hit on that a little bit. We've talked a little about it earlier. So chasing yield. You saw a lot of that, which basically caused the financial crisis. I reread the book, The Greatest Trade Ever, the past week. John Paulson and Michael Burry was in them, and them shorting the making money from credit default swaps and stuff. But anything to add on that?
No, I think that's true. If it's competitive. You could copy what other people are doing as long as you're doing inside your own organization. So stealing ideas from other people in terms of how more efficiently to run your operation, I think it could work really well. What you're talking about is more like thinking everyone's trying to exploit the same kind of marketing efficiency. We're talking about a commodity business, basically.
Yeah.
So
money's a commodity.
Right. Money's a commodity. And so you're all saying, we have this thing that we can all make money off of, but you don't have an edge in it, It would be the same sort of thing as what we do in investing and stuff. If someone went around and said, well, everyone's making money in, Japanese nets or whatever, then maybe it's not a good time to, or whatever it could be. It could, in arbitrage
Tech
things
stocks,
or whatever.
Arbitrage.
If everyone's making money in it and has been doing it for a little while, it's usually the time to get out of that. It's not the time to get into that, because, that's, markets are somewhat efficient that way. If there's a way to make money consistently, people should put more and more money into that, which should make the inefficiency get less and less, to the point that you shouldn't put more money into it, and it should reverse too. Both of those things are true, and so you should always be wary of that.
Getting back to like dancing while the music is still playing, I don't think people realize, and maybe our crowd does because everyone's investors in some capacity, right? But seeing other people make money and making, from chasing yield and staying on the sidelines, I think that's very hard for people to do from like a psychological perspective.
I agree. And I think that that's the unfortunate, and that's what I meant about Buffett selling the GSEs and stuff. That's the biggest thing, is that you know that you're doing it to be early and stuff, to sell something. You know that it's going to go up even more. and you're going to have to watch that. And people are going to say it was a mistake for a long time. And certainly that's true with financial things. I mean, at the point at which you realize that this bank or something is a mistake and you should sell it, it could be years before that becomes obvious to others because of what they're doing. So I think that is hard to do. And people always want that advice, whether it's market advice or advice about a particular stock. They basically, what they want you to do is tell them the perfect time to sell, instead of this is not right in terms of the risk return looking forward for you. You should get out of this and get into something else. If it goes up 100% before it then goes to zero, they're still going to feel like that was a mistake for a while. And obviously in many cases it won't, you could also be right about the risk that they're taking and stuff without it being right in how it turns out. But the truth is that the junkiest, most marginal in many ways companies taking the most risk should have the best returns for the period of time immediately before whenever there's a problem. So actually, if you sort of the George Soros thing, the reflexivity stuff, if you could actually figure out the bubble in something and the bursting of it, then you could make money by investing in things that are actually have a very bad long-term future, but will have a good future briefly. Because like we said with the commodity thing, it's a commodity. And, the best play on a commodity thing is the most marginal producer in the period of scarcity. Sure. So if you know that that's going to happen, but you know that on the other side of that, when it's no longer scarce, for instance, that you'd have been better off with someone with a lower cost position. You shouldn't buy the most marginal copper mine. But if you knew that copper was about to go through the roof, then actually the most marginal one's the right one to bet on.
Sure.
So I think that's true, that like watching other people make money. I notice that as the biggest thing in our industry about what changes people's minds and stuff is the difficulty of watching other people make money on things.
Oh, sure. Yeah. I would say, Twitter and all these other things, it probably doesn't help that situation the most. Yeah.
And that's why some things about today remind me of the late 1990s that way. Because that was a big factor in the 90s, I think, is people making money for a while, seeing other people make money and things and thinking, well, I could do that.
Well, I mean, look at how much flack he took as well when he made that, that speech at Sun Valley, Warren Buffett. And they said, people were just laughing and he's washed up and blah, blah, blah. And you know what happened there. So it's hard to do that. I think it's hard is that a personality type, you think? Is that something that you're born with?
Yeah, I think it is 100%. Because you have to look at things and just say the underlying numbers don't make sense this way.
At some point, the laws of gravity do apply.
Yeah. Where a lot of people will say like, well, it's sort of what I was saying before, that they could do a little bit of it or whatever. I see it a lot with value investors. They could do a little bit in some things. This is the best, this is the most value type thing of what they were doing before, but it's still crazy. They're buying something, over 10 times sales or whatever. We were just talking about a stock that's over 40 times sales. That's a whole different category of buying things than anything that's had to do with value investing in the past. Those are extremely rare. It's extremely rare to have things over 10 times sales in any year in most markets. There's a tiny number of stocks that would ever fill that. So our past experience is just so limited on it. So you're entering into a transaction that is almost without precedent in terms of any sort of value investing principles on it. Doesn't mean it won't work out, but I think sometimes people may fool themselves about how far they're going away from what they're used to doing, and saying, and they're
because they're making money too.
Sure.
Probably through the process, which only reinforces the bad habits. That's like one of the worst things that can happen to someone, if you think about it.
Yeah. Absolutely. But, all of AIG's derivatives things or whatever probably made money until the moment that they didn't because of how you're marking them.
Sure. Yeah, well, that was the whole thing, right?
Yeah, no, I mean, that's always going to be the case. I should point that out. Like, it's hard. For most people, you're not likely to lose huge amounts of money on things that don't go well because you would stop doing it. You wouldn't continually put more and more into it. So it has to be trades that are going well for a while. That would be something why that would happen. You don't suddenly start something and make a lot of loans into a category that you haven't made before, but they go well. And then over a period of a few years, you keep upping the asset growth in that area, like we talked about. And so that's kind of more of the reason why it happens. It takes several years. I mean, that's why bubbles work the way that they do. You have to have positive outcomes for a while to reinforce the idea. And that's what I think about with risk and stuff I talked about before. Risk habituation, I think, is what it is. It's having made money on something similar 5, 6, 7, 8 times, now you're willing to risk a lot on something, whereas you didn't when you first started. The novelty of it wore off. The idea that this is a risky bet has worn off. And so you're now willing to enter into it without having the same concerns about it, even though the real risk situation may not have really changed that much. The same risks may be present, and you're not thinking about it rationally. It's just that it's paid off for so long, or it hasn't happened. You hear that from people a lot of times. Like, say, let's say that you're worried about inflation risk or something now. Some people would say, well, people have been worried. I've been hearing about worries about inflation for 10 years. That's not relevant one way or the other, really. That's kind of like saying I've been hearing about risks of earthquakes for 20 years. It doesn't make it more or less likely there'll be an earthquake next year. So you have to be careful about that, because when you say that, what you're actually saying is that because I've heard this so many times and it hasn't happened, that's affecting how I perceive the risk of the frequency of this happening in the future, when that should not be what you're thinking about. It really should be independent of that. And so I think that, winning repeatedly in something is a way that can become a problem. And sometimes for investors, on a specific stock, if it does really well for a while and stuff, that might lead you to hold it and stuff. But more likely is people tend to sell and take profits on it. So more likely is repeating the same sort of thing, right? So like I bought this stock, it worked out. And so when I see the same sort of setup in something else, then I react to it the same way. That, I think, is more usually the risk. There's not a lot of people who buy a stock, it goes up a ton, they just hold it no matter what. There are some people who do that, but that usually isn't it. It's something that seems very similar to it. So they bought this stock when, so COVID happens or whatever, and they buy this stock in this situation. When something else happens again that puts that stock at risk or whatever, they'll be tempted to make sure that they buy it because of how quick the rebound was in it last time. Like it trains you to buy on that sort of thing, which could be good or bad. It's just depending on how close it is to the past that way. Yeah.
Got it. 7, the suggestion that banks can't evolve and innovate ignores centuries of evolution and innovation. So this is sort of a hot topic right now because of fintech.
Okay.
So do you have any thoughts on that? Will banks still be around for the next 100 years?
Yeah.
In some capacity? Will the best banks implement some sort of technology to their business to keep up with everything?
Sure. Yeah. There's sort of a division.
Agree with this.
There's a division of a few different things, and so like, will some of the functions of what banks do and stuff go away? Yeah, but a lot of them have gone away over the years for all sorts of different things. It's actually provided by a lot of stuff that banks used to do are now provided by securities markets that don't involve banks. So lots of things of that will change, but that they'll take in capital and use it in some way and stuff. I think, there'll be banks. Yeah.
8, true lenders have the courage to pursue what others denounce as simple and cliche. So they're looking for the 2-foot hurdles.
Yeah, that's simple and cliche sounds fine to me.
Do you like banks that specialize in a certain area?
Yeah.
As opposed to being, they kind of do a shotgun approach to it?
Yes. However, I mean, to be fair, you could do that because like part of your organization could be, same, whether insurance or banking, you could basically specialize in attracting money at a low cost, having low expenses and things like that, and then having a very diversified and non-specialized approach to the asset side. That's certainly possible. So I don't want to say that you couldn't do that, and that might be the best thing to do. Same as in insurance. You might be good at underwriting and take the approach that you shouldn't be thinking about investing at all, and I think that makes sense too. But yeah, I think that whatever function you're providing that is creating the value in your organization, then it's good to have that be specialized. Absolutely, yeah. And there's very few banks that are successful on like both sides, like we talked about. So usually a lot of the value comes from the asset side or the liability side. Having very low cost liabilities.
So low cost deposits.
Right, or the reverse of having lower charge-offs, and so having higher returns in terms of what the yields are and the net of those charge-offs and things on the asset side. So it's usually, we can't find a lot of banks where both parts are true, that they are making money equally on both sides and stuff like that. And true also, I think, with insurers. Unfortunately, people complain about it and stuff, but the ones that make a ton of money underwriting stuff don't tend to have these great investment returns or something. Yeah.
9, an easy litmus test for any bank is how it performed through the latest crisis. Something we always do is look at to see what happened through 08, 09, 2007 for every single bank. Mm-hmm. It's a good way to...
and the last crisis that involved, that was a particular risk to them and stuff. I do want to caution with that with people, because I know like whenever about Frost and stuff, people are all excited about how well they did in their financial crisis. Financial crisis was not a huge deal in Texas as compared to some places. Like you would want to look at the energy crisis stuff that happened in Texas and where all the banks failed and everything. There's quite a bit before that. Same thing with any state. Sometimes they can completely avoid something and they look safer that way, but it's not a good judge of how safe they are. So if you know that Canada had no problem in this, in some sort of crisis or whatever, then it's probably not best to look at that crisis, but to ask when was the last time that there was a big issue in that for that bank. Or same thing with what kind of lending, So when was there big issues in energy lending or a mortgage or whatever they happen to do a lot of, to really test it that way. Yeah.
10, highly efficient banks aren't necessarily those with the lowest costs.
Yeah.
He says the typical bank earns twice as much revenue as it pays out in expenses. So if a bank's goal is to improve efficiency, expressed as a ratio of expenses over revenue, it'll get twice the bang for its buck by increasing revenue relative to cutting costs.
Yeah. We've talked about that, like the different ways to calculate it. I don't really use the efficiency ratio, which is what banks use. I mean, I think it's important for certain kinds of banks, but we've talked about how, like, I would say you use the cost of deposits in terms of the net non-interest expense. And so that could be either having lower expenses of the non-interest portion of it. Yeah. So not the interest spread, but in terms of basically fees and expenses, separating out that. Yeah. The assumption there being that you can get commodity type returns. The logical reason for that is that if a bank was so efficient, either being able to charge high fees for things or having low costs, that it was able to attract money at a very low rate and stuff, then it could just buy all sorts of low yielding things or make all sorts of super safe loans, and would still have a decent return. The reverse, if you're so inefficient, the only way to make any money is by taking quite a lot of risk in terms of assets. And like the most extreme examples of that are the GSEs and stuff like Farmer Mac. The reason why they can make money by doing something that has a tiny spread that way is because they have like no expenses in what they're doing. And I talked about that, but their entire organization adds basically almost no expense
because there's no,
so it's purely a spread business.
Yeah, there's no branches or anything like that.
Right, and you're doing it in huge volume and all of that. So the closer that any bank approaches that, where it's all about the spread that you were talking about, then the better that is. And conversely, that's the reason why when people say like, should all banks be worth book value or whatever? No, if you're not if in the early years you're a small bank and you're not very efficient, actually you will, your biggest value is probably to someone else buying you, to be honest. Because you can see how inefficient it is, just how much the cost is relative to other ways of having capital. It's sort of like if you had a closed-end fund and you had $10 million in or whatever, and you had a fixed level of expenses. Well, if you have a 5% expense ratio or something, unless you suddenly attract a lot of assets, you can't fix that problem. You're always going to underperform, and you should always trade at a discount to net asset value for that reason. But if you had a closed-end fund that was perfectly good at investing money and had a really low expense ratio, there's no reason why it should trade at some giant, discount to net asset value.
I was watching an interview and Bill Miller was talking about, he went and spoke with Peter Lynch one time and he knew some of the positions in Peter Lynch's portfolio. And I think Bill went and talked to him about Fannie Mae. Okay. And asked him why he liked it. And Peter Lynch basically said, you know what a bank does, right? Yes. Okay. How does a bank make money? Okay. I know how a bank makes money. And then he was basically talking about how Fannie Mae is going to have basically no expenses. Right. And then Bill asked him something along the lines of, okay, well, why aren't they making money today or something? And he said that Peter just said to him, well, that's for you to figure out. And then he said that he went and did more research on the company and came back a couple of days later or sometime later, basically said, oh my God, in a couple of years, this is going to be huge. And there's so much scale here. And this is going to be such a cheap price for this business. And Peter was like, exactly.
Yeah.
Kind of cool, huh? That's true.
Yeah. So, I mean, because that's what we're talking about, you know, again, using comparison in commodity things. It's the same idea with commodities. I mean, imagine if there was a business instead, you know, imagine there's a mining business, but instead of it, the government had guaranteed that you'd be supplied with X amount of copper at a certain price.
Yeah.
If the market price is higher than the price they're going to supply you at, and you have no actual operations, that would be a great business.
Yeah.
Well, that's what the GSEs were.
Mm-hmm. Got it. 11. History teaches that bankers face nothing new under the sun. Leverage is the friend of good banks, enemy of the mediocre.
Yep, same as in the insurance things. So people always ask me if I like a lot of leverage, don't like a lot of leverage, whatever. It's leverage.
Depends on
it depends.
people running
you know,
it.
Like I said, like, you know, I always mention that with Progressive, as excited as people are about it and stuff. I do mention, you know, that's great. And that's how they make their money. And so you really have to focus on their underwriting and stuff. But they are doing it at 3 times or so the level that some others do. And so you have to be very aware of that. Mm-hmm. That's both what creates a lot of the value and also what the risk is. So you then have to watch what's being leveraged very carefully. So, yeah, absolutely.
13, in banking, strategy matters less than execution. He writes, some banks grow by paying a discount for troubled banks. Others grow by paying a premium for well-run banks. Some banks prioritize dividends. Others repurchase lots of stock. Some banks centralize risk management. Others distribute it. There is no one right way to run a bank.
Yes, I agree with that. And generally with banks, unfortunately, they're not even going to have a dominant strategy that they pursue for a long time on that stuff as much as other kinds of businesses, because in the U.S. and stuff, they're rarely controlled by insiders, families, things like that. So they tend to be on that stuff much more run-of-the-mill and stuff. Mm-hmm. There are some differences where some very small banks were started by somebody or whatever, and they've grown to a certain size. So you might get a generation out of something. But remember, a lot of banks are really old and are long past the point in which they had any sort of, I mean, you just don't get unique capital allocation and stuff at most banks. It doesn't happen. Yeah.
14, an ordinary bank generates more capital than it can responsibly reinvest in organic growth.
Yes, that's the big problem and why they have the big asset growth issue. And that's something that I've warned about a lot. You know, I've talked about with people, like, you can do a calculation of that, of what's your return on equity. I mean, that's the simplest way of doing it and everything. Then how much are you going to have to get rid of in some way, because it's not possible to grow at that level. So people will look at that and say, oh, this bank has a 15, 16, 17% return on equity. Isn't that great? But then what are they going to do with the rest of the money?
Yeah.
So because it may be appropriate to grow at 8%, it could be. It depends on what you're doing. It may not even be appropriate, but that's possible. But 18 is unlikely for any length of time. So you have to decide about that quickly. Now, of course, you can bring down or up leverage briefly for a few years, but you have to address that. And so the easiest way to do that for me usually is just to pick 2 points at a time and show you how that would work and what would happen. And that's how you see that banks get in trouble and stuff. Because if you do that math, sometimes you go, okay, that means that they'd be super excessively overcapitalized within a pretty short period of time. So they're going to have to try to figure out something to do.
And a lot of times it's just paying that out in dividends or doing special dividends or reinvesting
recently,
it.
In some cases, I would agree with that recently and stuff. But in a lot of times it's not. People have been okay with that with banks since the financial crisis. But when we went back there to other periods, you know, business magazines and stuff at other times will reward the ones that look more growth-like and everything and talk about why aren't you matching their growth and all that sort of thing. But yeah, for the last few years, it's sort of like energy recently. You've seen that in energy. So what's been rewarded by investors and by the press and all of that is, hold back your production and stuff, even though prices are going up and all that. And so you see that behavior. But like 8 years ago or so, it was the opposite. It was telling them, why aren't you growing your reserves? Why aren't you doing that? You know, that kind of thing changes. And the same thing will happen. At some point, people will say, why aren't you growing as fast as these other banks and stuff? Right now, we're still close enough to the financial crisis and all the things that happened, and that people are like, get the high returns on equity, pay it out in dividends and buybacks and all that sort of thing. But at some point, they'll be like, you know, be a growth stock.
15, it's this consistency, not the amplitude of earnings, that drives long-term value in banking.
Yeah,
I would say that's true. I mean, that's a lot of public companies, like how the stock does, right?
Yeah, if you narrow it down to a certain level, I mean, there's 2/3 or something of banks that probably you wouldn't want to be invested in just because the earnings level is too low in terms of returns on equity and stuff like that. So I would be cautious about that. Return on assets, really. I mean, you know, the leverage part can change, but yeah, I'd say that's true. They shouldn't. It's the consistency that matters. Yeah.
16. It pays to act with alacrity in a crisis.
Yeah, it just means be quick, swift.
I had to look that word up because I've never seen that word before and how to pronounce it. So there you go. And he writes, run your business knowing it might be sunny, it might be stormy, or in fact, it might be a hurricane, Jamie Dimon once said. And be honest about how bad a hurricane might be. When crisis strikes, it's best to prepare for the worst.
Mm-hmm. Yeah, and I think people are okay with that now because we had a crisis 10 years ago. So these are all things that people would agree with now, yeah.
17. Efficiency and prudence are in harmony, not conflict. He says, being a low-cost provider bestows tremendous strategic advantages on a bank beyond immediate profits. An efficient bank can be competitive on the asset and liability sides of its balance sheet, making better loans to better borrowers and securing a more stable source of funds, yet still earn its cost of capital.
Yeah, I agree 100% with that. In fact, the issue is that the inefficiency makes it so that the more inefficient the organization is, the more difficult it is to the more risk you have to take, basically. Yeah. So I agree with that. And we talked a little bit about
to
that
earn
before.
the yield.
Honestly, sometimes there are banks out there and stuff that just to earn a fairly decent return requires much more risk taking. Because if you look under the hood, the inefficiency is there. So they can't do that well. It's kind of like maybe the easier thing for people to think of is an insurance company because they literally use the combined ratio, so you know that, and their cost of float and everything. So obviously, if you had higher expenses, right? So you say you have higher expenses than Geico or whatever, you'll produce the same amount of float as they will, but you're going to earn nothing on it, whereas they have a 5% underwriting profit or whatever. Well, then what do you do with that? You then say, okay, well, I have to invest in assets that have higher yields and stuff. And also you probably say, I need more leverage, more investment leverage. I need to generate more funds to make this money, and so you see that. And that's actually a big part of it with banks during the crisis and stuff that isn't necessarily talked about that way. Why would you have all these off balance sheet things and stuff? It's because of the efficiency issue. That efficiency in terms of the per unit of capital that you have on the balance sheet, what can your returns be? The easiest way to fix an inefficient operation is to up leverage. I mean, it's actually what we talk about when I talk about my worries about things with China and stuff, is that you're becoming less and less efficient in some of these operations in terms of per unit of capital. And so how do you fix that? Most, say a property developer doesn't fix it by saying I'll slow down my growth. They say I'll fix it by upping my amount of assets versus my equity, and I can get the same result. Same thing here. The less efficient you are on like a return on asset basis, on like the cost, on all those sorts of things, makes it okay. Now I have to have more assets relative to my equity, and I have to have a bigger spread. How do I get those things? You can imagine those things are taking extra risk. The easiest way to take a low amount of risk is to be so efficient that you don't need to take that risk. Yeah.
18. Given the near infinite demand for a bank's principal product, which are loans, the onus is on each bank to govern its own growth.
Yeah. I think that's true.
Basically, just be prudent about it. A lot of people there's always ideas for... It's all back to the type of risk and the type of lending that they're doing and their views towards lending and risk.
Yeah, what I would say when talking to investors and stuff always is like, this bank is growing faster than that local economy or whatever. So start from that basis and think about, so what does that mean? And
what are they doing?
Is that a problem? Obviously we can't all grow faster that way unless the entire country is going to have rising credit as a percentage of all sorts of activity over time, which you can have for a generation or whatever, but same as with an organization. So it's different than other businesses. I think you have to be really worried about asset growth that way. Whereas, growth in revenue at a food company is usually a sign that the brand might be underpriced. It might be that people who use it then want to repeat buying and all of that. That is not the case with a commodity product like this. Well,
we were talking on the way over here. If a bank is growing its C&I lending, pretty rapidly, and those are a couple year loans, it's like eventually that's going to dry up, or you have to keep making those loans to just sustain that growth. And that's very hard
we talk about that
do.
In terms of looking at the balance sheet and stuff, how quickly things come back to you. Yeah, absolutely. I mean, banks have to do more lending than you might think, unless the loans are very long term and stuff because of how quickly they'd be paid off and everything. So that is a big issue. As opposed to compared to life insurance or something, to a very significant extent, you're just a renewal business, on that. Yeah.
19, the biggest challenge for banks is to narrow the gap between the perception and reality of banking. He says bankers are often portrayed as greedy fat cats who get rich from, quote, other people's money, yet in virtually any important civic organization, in virtually any community, you'll find bankers playing a leading role.
Yeah, I'd say the perception of banks is pretty negative, sure.
20, this is my favorite one. Success in banking is first and foremost about winning a war of attrition. More than 17,300 banks have failed since the birth of the modern American banking industry 160 years ago. That's over 3 times the number of banks in business today.
Yes. Although true for many, many industries, right? I mean, how many car makers failed and how many are left?
Sure.
Right. Yeah. I think there are some industries where that's not true, but any industry that's incredibly old will have this as a feature of it. Absolutely. Over a long enough period of time, most companies go to zero.
And in the banking world, why is that?
Well, a lot of those...
Does it go all, start bringing it back to the asset side? When Buffett says banking is a great business unless you do dumb things?
Yeah. If you're taking risks that could, in a worst case scenario, wipe you out, and then you last longer than 100 years... eventually you'll hit that worst case scenario in a big way. Right. So I would say that that's a very big factor on it. Yeah. So likely you're taking risks all the time that occur infrequently. And then you have a long enough lifespan, then you'll hit what those risks are. Yeah, absolutely. Got it.
Cool. What a great way to end this podcast. Make sure you go to John's website, maxfieldonbanks.com. It's a great place to, I like this essay a lot. I look forward to his future essays, and then also go work your way through all the books that are on his website. I'm going to put all of his information down below. John, thank you for this essay, and I'll also put his Twitter out there as well. So I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. Make sure you hit the subscribe button wherever you are listening or watching us here today. If you want to get access to the website that Jeff and I use every single day, go to quickfs.net to pull long-term financial data. It is quick, it's easy, hence the name QuickFS, financial statements. Tell them that you came from Focus Compounding during checkout if you do decide to subscribe. Thank you so much for all the support, and we'll see you in the next podcast.